Welcome to the Byte-Size Brief. Today we are putting IBM, that's IBM, completely under the microscope. Let's get into it.
Yeah, I'm really looking forward to this one. It's quite the story right now.
It really is. I mean, we are opening up the sources on a century-old tech giant, right?
Yeah,
A company that used to just be synonymous with those massive metal boxes. And today we're tracking their aggressive, really high-stakes attempt to reinvent themselves as an agile, AI-first, hybrid cloud powerhouse.
right. And it's not an easy pivot.
Not at all. So the real mission for us today, for you listening, is to figure out whether this stock is actually worth retail investor attention right now, or if the market's brutal reaction recently was entirely justified.
Exactly. Because it really is the defining corporate reinvention story of the decade. And the stakes, I mean, they honestly couldn't be higher. They are trying to change the engine of a commercial jet while it's in midair, carrying thousands of Fortune 500 passengers.
That is a great way to put it.
They just can't afford a single drop in altitude, right?
Mm.
But they desperately need to upgrade their fuel system before they get left behind entirely by the rest of the tech sector.
Which brings us to the ultimate paradox facing the company today. Because if you look at the raw data, they just reported their absolute strongest start to a year and a decade. And yet, and this is wild, the stock completely tanked. It dropped right off a cliff after hours.
Yeah, it dropped hard. It's a classic market paradox, really. And it sets up the central debate for us today. You see, while the retail crowd often chases the headline hype, the big revenue beats, the flashy AI announcements.
Right, stuff that looks great on a newsfeed.
Exactly. But the institutional market, they are ruthlessly demanding forward-looking acceleration. They're looking at the math of tomorrow, not just the victories of yesterday. So the fundamental question we have to answer here is IBM a misunderstood value play right now, or is it just a classic value trap?
Well, let's unpack this narrative shift first, because the blue renaissance, as some analysts are calling it, it's built on a totally new foundation. IBM is no longer just a hardware company.
Not at all.
The revenue pie has fundamentally changed. Today, they're heavily tilted towards software, which makes up about 45% of their revenue. Then you have consulting at 32%, and infrastructure, the old legacy metal, is down to just 18%.
Right. And that's the deliberate result of CEO Arvind Krishna's master plan when he took over. He basically spun off the declining managed IT services business into a separate company called Kyndryl.
Oh, yeah, the Kyndryl spinoff.
Yeah. And then he doubled down on the Red Hat hybrid cloud playbook. He basically made software revenue growth the non-negotiable metric for the entire organization.
And looking at the Q1 2026 numbers, I mean, it really seemed like that playbook was working flawlessly. Let me just hype up these numbers for a second, because from a retail perspective, they are phenomenal.
Go for it.
They reported $15.9 billion in revenue. That's up 9.5% reported, or 6% at constant currency. Earnings per share shot up 19% to $1.91. And they posted a massive gross profit margin of 57.7%.
Yeah.
I mean, if I see a report card like that in my portfolio, I am expecting a parade on Wall Street.
Well, on the surface, absolutely. But here is the cold, hard reality check that institutional investors ran. Despite those massive top and bottom line beats, the stock plummeted over 7% after hours. It slid from the 250s all the way down to the 230s, leaving a lot of casual investors completely baffled.
Okay, hold on. How does that actually affect IBM's stock price for regular investors like me? If they clearly beat Wall Street's own expectations, why did Wall Street immediately punish them?
It all comes down to the valuation problem and the carrying cost of their multiple. Right now, IBM is trading at a price-to-earnings ratio, or PE, of around 22.5. Historically, for a slow-moving legacy tech company, that is a premium multiple. When the market prices you at 22.5 times your earnings, they aren't just rewarding you for what you just did, they are demanding accelerating, compounding future growth.
Oh, I see. So it's about what's next.
Exactly. The market looked at the quarter and basically said, great job, but we already priced this perfection in 6 months ago. Where is the exponential AI upside to justify taking this multiple to 30?
Okay, so compared to last quarter, what actually moved the needle here? Because to beat those estimates so soundly, something had to go incredibly right under the hood, even if the market wasn't satisfied with the future promises.
Right, let's break it down into the structural improvements and the deteriorations. The good was undeniably software and infrastructure. Software growth hit 11.3%, and that was driven heavily by their data products, which spiked 16%.
Wow, 16% is huge.
It is, and that's a direct result of enterprise AI demand scaling up. Companies are desperately organizing their data so they can actually use AI in the first place. Then, infrastructure unexpectedly surged 15.3%.
Wait, which is wild considering we just established that infrastructure is the shrinking legacy piece of the pie.
Huh.
What caused a 15% spike in metal?
Well, it operates on a massive multi-year upgrade cycle. This sudden surge was primarily due to the new Z17 mainframe cycle finally shipping. They delivered over 100% growth in new MIPS capacity.
MIPS.
Yeah, MIPS. It stands for millions of instructions per second. It's essentially the raw horsepower metric for these mainframes. Add to that, their free cash flow actually increased by $300 million year over year to hit $2.2 billion. Those are the tangible improvements.
Okay, that all sounds incredibly healthy. So where did the deterioration happen? Where's the bad news?
The bad started with consulting. It was remarkably sluggish, growing at just 4.0%.
Oh.
Yeah. When you are aggressively pitching yourself as the premier company that will guide other global enterprises through their complex AI transformations, you really need your consulting arm growing significantly faster than a mere 4%. But the real anchor that dragged the entire stock down was the forward guidance. It was completely flat.
Flat, like they didn't raise it at all.
Not at all. Management blatantly refused to raise their full-year guidance. They stuck to the exact same forecast of greater than 5% revenue growth and a $1 billion free cash flow increase that they had projected before the quarter even started.
Oh, man. So basically, it's kind of like getting an A+ on your midterm, but telling your parents you're still only aiming for a C+ on the final. No wonder the market panicked. You can't post a blowout quarter and then tell everyone the rest of the year is going to be mediocre.
That is a perfect analogy. The market despises an A+ student who refuses to raise their own bar. And to add, a heavy layer of complexity to this flat guidance, we really have to look at the Confluent factor. IBM closed their $11.6 billion acquisition of Confluent early in the quarter.
Which is, that is a staggering price tag.
It's massive. Now, sure, it brings $69 billion in remaining performance obligations, which is essentially a huge backlog of guaranteed future revenue.
Yeah.
But it also adds severe integration risks and pushes their total long-term debt to an eye-watering $57.7 billion.
Right, and with interest rates where they are.
Exactly. Wall Street looks at that debt load in a high-interest rate environment, looks at the flat forward guidance, and decides to just take their profits and step back.
I can see why the institutions took their chips off the table then. But building on that conservative guidance, you really have to wonder if CEO Arvind Krishna is seeing something the rest of the market isn't. Because almost everyone else in the tech sector is projecting endless vertical AI growth.
He absolutely is seeing something else, and he's being highly vocal about it. Krishna is actively warning the market of a massive, impending AI infrastructure bubble.
A bubble already?
Yeah, and his math is fascinating and honestly a bit terrifying. He calculates that the industry is currently committing to over 100 gigawatts of AI data center build-outs globally. At $60 to $80 billion worth of semiconductors and infrastructure per gigawatt, that points to a $6 to $8 trillion capital expenditure build-out over the next few years.
But wait, let me push back on that. How can Arvind Krishna confidently call it a bubble when Microsoft, Google, and Meta have some of the smartest financial modelers on Earth backing the spend? Is Krishna actually a visionary here, or is this just sour grapes because IBM completely lost the consumer AI race to OpenAI?
It's a totally fair critique. But Krishna's argument is rooted in basic depreciation math, not emotion. To pay back a $6 to $8 trillion hardware investment over a standard 5 to 7 year server depreciation cycle, Krishna estimates the tech sector will require $1 to $2 trillion in incremental, brand new annual revenue.
Wow.
Yeah, that is net new revenue that he firmly believes does not currently exist in the global market. He argues that the hyperscalers are trapped in this irrational arms race, building infrastructure for consumer demand that just won't actually materialize fast enough to pay off the debt.
Right, but what does all that actually mean for IBM investors? If the whole tech wick is in this hyperscaler arms race, where does that leave our stock? Are they just sitting on the sidelines?
It means IBM is playing a deeply contrarian, highly specialized strategy. Instead of bleeding billions in the hyperscaler bloodbath trying to build the next consumer chatbot, IBM is playing the enterprise long game. They strictly avoid building massive public models. For context, the biggest frontier models out there are pushing past 1 trillion parameters. IBM intentionally caps its Granite family of models at under 100 billion parameters.
Wait, let's pause there. For those of us who aren't data scientists, what does a parameter actually mean in plain English? Is that just like the size of the AI's vocabulary?
Good question. Think of parameters as the number of neural connections or synapses in the AI's brain. A trillion parameter model is a massive generalized brain trying to understand everything from Shakespeare to quantum physics, which takes enormous amounts of power and money to run.
Okay, so it's a generalist.
Right. A 100 billion parameter model is a smaller, highly specialized brain. It doesn't know how to write a sonnet, but it is an absolute genius at reading complex legal contracts or, parsing financial supply chains.
That makes total sense. So they are staying hyper-focused.
Precisely. They build these small, hyper-efficient domain models, and crucially, they run them locally for enterprise clients. Think about a major global bank or a national healthcare provider. They are terrified of sending their proprietary, highly regulated data out to a public cloud to be digested by some massive public model.
Oh, yeah, the compliance alone would be a nightmare.
Exactly. So IBM rents them the compute, installs these efficient Granite models behind the client's own firewall, and focuses on automating actual business tasks, procurement, accounts payable, highly regulated risk decisions.
And this connects perfectly back to that $11.6 billion Confluent acquisition we talked about earlier. In the sources, it mentioned Confluent provides a Kafka backbone. Hold on, you just dropped Kafka backbone into the mix. I know Confluent is huge, but what actually is a Kafka backbone? Are we just talking about a really fast data pipe?
It is much more than a pipe. It's an open-source event streaming platform. Imagine a bank processing thousands of credit card swipes, mobile app logins, and ATM withdrawals every single second.
Right.
A Kafka backbone doesn't just store that data somewhere. It streams it in real time as a continuous flow of events. By integrating Confluent, IBM can take a company's secure, real-time event stream and feed it directly into those specialized Granite models instantly. It creates a closed-loop, highly secure AI pipeline that completely bypasses the consumer AI bubble.
Wow, so they're building these ultimate zero-latency secure fortresses, but to run that kind of specialized real-time enterprise AI locally, you need serious heavy-duty iron on-premise. That brings the conversation right back to IBM's legacy crown jewel,
Yeah.
the mainframe.
The exact hardware everyone assumed was dead a decade ago.
Well, wait, I shouldn't say exactly, because
Yeah.
there was actually a massive viral panic among retail investors on Reddit recently that directly challenged this hardware.
Oh, right, the Anthropic demo?
Yes. Anthropic, one of the big AI labs, showed off an AI that can translate old COBOL code perfectly into modern languages like Python or Java. Retail investors absolutely lost their minds. They were terrified this would destroy IBM's ultimate moat, because mainframes famously run on decades-old COBOL. It actually led to a lot of retail stock sell-offs because people thought the mainframe era was officially over.
Which is a textbook example of why retail panic often completely misses the institutional reality. Let's firmly debunk this narrative right now. First of all, IBM's own watsonx platform has been doing AI-driven COBOL translation for its clients for quite a while now.
Oh, really?
Yeah. Anthropic did not invent some magical bullet that IBM didn't already possess, but far more importantly, the Reddit crowd fundamentally misunderstands the core reason clients use mainframes in the first place.
They think it's just because the banks are trapped in old code and can't afford to rewrite it, right?
Oh, precisely. But clients do not pay millions of dollars for mainframes because they have some weird nostalgia for COBOL. They pay for what the industry calls 6 nines of availability. That is 99.9999% uptime.
Wait, what does 6 nines actually mean in practical terms? Like, how much downtime is that?
It means the system is allowed to be offline for a maximum of 31.5 seconds per year, total.
Wow, 31 seconds a year.
Exactly. They pay for absolute, bulletproof transactional integrity and security. We are talking about the core ledgers for credit card authorizations, retail banking, global airline reservations. If those systems go down for 5 minutes, it costs millions of dollars and creates international chaos.
Right. Nobody wants their flight canceled because of a cloud outage.
And furthermore, moving those specific high-intensity transactional workloads to the public cloud is economically irrational. Krishna himself noted it would cost clients 3 times as much to run those exact workloads in a distributed cloud environment.
And IBM is future-proofing this dominance with the new Z17 platform I mentioned earlier. The specs on this hardware are just jaw-dropping.
They really are. The Z17 isn't just a faster processor. They have engineered a mini GPU directly onto the main processor itself. They call it the Spire card. This allows for on-platform AI inference without ever moving the data off the secure box.
Let me stop you right there. You said it allows for 450 billion inferences per day. What is an inference exactly? Is that just a fancy word for a database search query?
Not quite. An inference is the actual moment the AI flexes its brain. It's the moment the model takes in brand new data it has never seen before, analyzes it against everything it has learned, and makes a real-time prediction or decision.
Oh, wow. Think about the sheer scale of that for a second. 450 billion AI decisions per day, natively on the processor at zero latency.
It's massive.
For something like credit card fraud detection, this completely changes the paradigm. Before, banks had to sample data lake. They would run complex AI fraud checks on maybe 1 out of every 10 transactions because sending every single swipe out to a cloud AI was simply too slow. Now, they can do true inline screening. Every single swipe is checked by AI instantly, right there on the mainframe, before the transaction is even approved.
And that is the monetization vector that the institutional market is slowly waking up to. The mainframe is no longer just a legacy ledger holding old data. It is transforming into an ultra-secure, zero-latency AI engine.
So they're building these ultimate hardware fortresses with the Z17, but, security is always a moving target. If I am a CIO at a major bank buying a mainframe today, I am terrified of the horizon. I'm terrified of what happens when quantum computers finally arrive and just shatter current encryption standards. Is IBM actually future-proofing this hardware against that threat?
They are, and it bridges our discussion perfectly to IBM's ultimate decade-defining bet. The Z17 actually includes post-quantum cryptography baked right into the silicon, which leads us to their moonshot, quantum computing. CEO Arvind Krishna has made a remarkably bold claim here. He stated publicly that he has 100% confidence in delivering a commercially viable scaled quantum computer by 2029.
I have to say, 100% confidence is a phrase you almost never hear a Fortune 500 CEO use when talking about unproven theoretical physics.
It is incredibly aggressive. Right now, the world's best quantum processors are sitting in the hundreds to low thousands of qubits. To hit that 2029 target, IBM has to achieve a 10x scale-up in physical qubits and a simultaneous 10x improvement in error correction.
That's a huge leap.
It is. But Krishna likens the state of quantum today to where GPUs were back in 2015, a nascent, highly specialized technology that is about to see an explosive, insatiable demand curve.
Before we get into the business applications, can we just ground this? Because quantum math is totally different from the binary ones and zeros we are used to. How does it actually solve problems faster than our current supercomputers?
Well, think of a classical computer trying to solve a complex maze. It's like a person walking down every single path, one by one. They hit a dead end, turn around, and try the next path until they eventually find the exit.
Right. It works, but it takes enormous amounts of time.
Exactly. A quantum computer, leveraging superposition, is like flooding that entire maze with water. It explores all possible paths simultaneously, finding the optimal exit instantly. It harnesses quantum mechanics to solve combinatorial problems that would literally take classical supercomputers thousands of years to calculate.
Okay, so what is the actual ROI here? If they pull this off by 2029, who is buying it?
IBM is targeting 3 immediate commercial applications that make this a multi-hundred-billion-dollar franchise opportunity. First is materials science designing better anti-corrosion coatings, discovering new pharmaceutical drugs at the molecular level, and creating novel rare earth-free magnets for electric vehicles.
That's huge. What's the second?
Second is financial risk doing real-time pricing of immensely complex derivative portfolios during the actual trading day, rather than waiting for overnight batch processing.
And the third application blew my mind when I was looking over the sources. Global logistics optimization.
Yes, solving the notoriously difficult routing problem. Right now, approximately 30% of global trucking routes and shipping containers run completely empty, simply because the logistical variables, weather, fuel costs, traffic, delivery windows, are just too mathematically complex for classical solvers to optimize efficiently.
30% empty. That is wild.
A quantum computer could evaluate all those variables simultaneously and eliminate that systemic waste.
But here is the multi-billion-dollar question. How does a traditionally slow, highly bureaucratic, 100-year-old company actually reach a 2029 physics moonshot like that? You don't achieve quantum supremacy with a slow-moving, risk-averse corporate culture.
You really don't. And recognizing that required a massive cultural shift internally. Krishna implemented a mandate across his engineering and leadership teams that he famously calls the pleasure of being fired mentality.
I love that phrase. It is so counterintuitive for corporate America. Normally, everyone is just trying to protect their turf.
It traces back to his own mentors and his father's military background. He recognized that a declining firm naturally becomes paralyzed by risk aversion. Employees focus entirely on protecting their jobs rather than innovating.
So how did he fix it?
His fix was to drastically lower the confidence threshold for action. He literally tells his engineering teams, do not wait until you have 90% confidence to bring me an idea. Give me your 50% confidence and let's lean into it right now. He is actively forcing the company to take rapid, calculated risks, fully acknowledging that timelines might slip or things might break, rather than stagnating in endless, safe planning cycles.
So what does this all mean for us? Let's synthesize this deep dive. IBM is making a massive, highly calculated divergence from the rest of the tech industry. They are betting their entire century-old legacy that the future of enterprise tech is not about consumer chatbots, but about absolute trust, data sovereignty, and specialized local AI.
Exactly.
They are actively betting against the massive $6 trillion infrastructure bubble that the hyperscalers are inflating. If Arvind Krishna is right about that overbuild, and if the consumer AI bubble pops or faces a severe correction, IBM's conservative, high cash flow, enterprise-first strategy could make them the ultimate safe haven in the tech sector.
It is the ultimate tortoise in the hare scenario. But in this case, the tortoise is armed with a highly profitable consulting arm, impenetrable mainframes, and a rapidly advancing quantum computer. They are not trying to win the AI sprint. They're quietly building the secure infrastructure for the next 20 years of corporate computing. The primary risk, of course, is if the public frontier models advance so quickly that they manage to commoditize IBM's specialized closed-loop approach before that 2029 quantum target is actually realized.
All right, listeners, what is your take on the future of IBM? Are you bullish on their contrarian enterprise AI strategy? Are you bearish because of their flat guidance and massive debt load? Or are you sitting on the fence waiting to see if they can actually pull off this quantum moonshot? Let us know in the comments. See you next time on the Byte-Size Brief.